Personal Finance on Lunchtime. Brought to you by the Irish Times. Now with dedicated daily business supplements.
Right, up in the big chair in our Dublin studio while I'm here in Opera Lane is our money doctor, John Lowe. John, good afternoon to you.
Good afternoon, Jonathan.
Well, the first question I have to ask you, is Cheltenham a good investment in John Lowe's opinion?
Yeah, well, the money doctor, I can tell you, Jonathan, is not a gambler. So I actually, unfortunately, I have to say I like horses and I like the sport, but I'm an avid anti-gambler, I have to say.
Right, well, I have to say I don't know one end of a horse from the other, so me offering tips is rather pointless, but thankfully there are others around me who have a slightly better idea. OK, John Lowe, our money doctor, with us as he is every single Tuesday, author of the best-selling Money Doctor Finance Annuals. John, before we go to listeners' questions, and a lot have come in again, and we thank everybody for getting in contact, I want to talk about this Fianna Fáil private members motion that's being brought before the Dáil today. I mean, they want the government to put pressure on permanent TSB to lower the variable interest rate being charged to its mortgage customers. We'll talk about the rate itself in a minute, but the government really can put pressure on permanent TSB to do anything, can it?
They can, and it's this isn't a historical really question, because you've got to go back, say, 4 or 5 years, Jonathan. Permanent TSB had lent out 40 billion, of which 60% of that 40 billion were tracker mortgages. So it's killing them. You know, if the cost of funding is around about 5-6% currently, and they're letting these trackers off at 1% over the ECB rate, or less, in fact, 0.75. So that's 1.75%. You can see that they're losing hand over fist. One of the issues, therefore, is that they had to maintain the standard variable rate up at a high level. Huge anomaly. 5.19% is their current rate, Jonathan. But, if you asked any existing mortgage holder in the permanent TSB, it's about 5.8, 5.9%. So
wow, okay.
It's a lot higher. But you compare that, though, to, the cheapest option for, say, first-time buyers on the market, AIB, even if you're getting 92% with them, it's 3.24%. So that's nearly 2% cheaper just on the standard variable rate. I cannot see how the government can force permanent TSB, who are losing hand over fist on these mortgages, to force them down to the levels of, say, the AIB.
Well, there is some suggestion that there's a deal being done to take the tracker issue away from AIB and permanent TSB. That's more medium term, I would suspect. But the bottom line is, if you're stuck on a variable rate for permanent TSB at the moment, you're getting screwed, and of course you can't change.
Well, if yes, it depends, of course, on the loan to value. It also depends on your ability to repay your income. So loan to value, obviously, it'll have to be 80%. Even AIB, by the way, won't even take switchers. So even if you were if you met the criteria of income, you met the criteria that your loan to value was less than 80%, AIB don't want it. Bank of Ireland, though, will take it, and so will other lenders out there, KBC. But you have to comply. You have to have a loan to value of less than 80%, and unfortunately there's a huge number of people who are not in that way.
Because of negative equity? Because of
negative equity. But they haven't certainly got 80% loan to value. A lot of people would have lost 60% of the value of their property in the last 4 or 5 years. 60%. Okay. So anybody who got a loan, certainly in the last seven years, have been affected.
Yeah, and it's worth noting as well, permanent TSB, I think that at the end of 2011, something like 11.5% of their home loans were more than 90 days in arrears. So, you could probably extrapolate from that people who are on variable mortgages are really, really struggling to pay those interest rates.
Well, the tracker rates as well went in November 2006. A lot has to do, Jonathan, with also liquidity and solvency. The ratio that the banks were looking for were 1.25. In other words, for every 125 billion of lending, you wanted 100 billion of deposits. Put that into context. Bank of Scotland, for instance, Ireland, who've unfortunately stopped lending and have now kind of gone across the way of the water to the H-Boss Lloyd's bank, who are owned by them. They basically had 33 billion lending, of which they brought in 6 billion in deposits. Their ratio was 5.06. Now you compare that to, for instance, the permanent TSB of, say, about 4 years ago, which was 3.1. 3.1. So compared to the 1.25. In other words, they're way out of sync. They're, as I say, they're theoretically illiquid. God be with the days, by the way, when, the old days, 300 years ago, Johnson, you had €100 taken in by the money lenders. They kept back £20, rather than euros, £20, and they lent out £80 at a higher rate. And therefore, they got their profit from the margin differential. It's changed all around.
And we know how badly wrong we got it when we changed the system. Okay, look, we could talk about that forever, but we'll move on to some of the questions that have come in, John. First is a message that came in by text. It says, I've 20 grand to invest. Could John recommend where to put it so that capital will be secure? So this person wants more than anything else the capital to be secure.
Well, okay, you're looking at really effectively cash deposits, gilts, government bonds, or guaranteed investment products. And there's a lot of those around. The cash deposit, if you're looking at security, then they're talking about the deposit protection scheme, which virtually all the banks over here would have up to 100,000 per person. And then you've got all the state saving products, and they're covered under the sovereign debt guarantee. So, but remember, the greater the safety, Johnson, the less potential profit. So the reverse is true as well. Risk has its rewards. Like you put your money on the horse in Cheltenham, but you can lose it all. The best way to do it is, of course, is have a bet on every horse in the race, and then you can't lose.
You're about to lose. While this, you do that, otherwise we all do it.
Okay, well, while this tidy sum is relatively modest, the percentage invested in risk really should be no more than 10 or 15%, but that depends on your age, family and income. I keep going through this on a weekly basis, but I think it's important to remember this, that, while you want to lock this sum away, you've got to ask yourself those questions, what's the long-term purpose of this money? Many investors don't address this question. And of course, another lot, by the way, forget to spend it. I'm not suggesting that you should go to Cheltenham and spend it, but certainly I think that you need to have a philosophy. You need to have a focus on where this money is going to in the end game.
Okay. There is another question that's related to that. Someone who has 25 grand, they want the best return, of course, but they're willing to put it away for at least 5 years. So, again, what would you recommend in that scenario?
Again, I would first of all query, again, the personal circumstances, age, family, all the rest of it. But if they want to stick it away for 5 years and they want to then take it into an investment whereby it's, risk-free, you're in your cash or your government bond area, well then, the state savings on the 5-year level would be the best of all. At 5 year, 6 months is their national savings certificate. It's 21%, Jonathan, into your fist, tax-free, which is equivalent if you had to go to an institution that gave you an interest rate with the dirt tax deducted from it, 5.04% each year for the 5 years and 6 months. So,
but the thing is, you have to leave it there, don't you? You can't take it out halfway through.
Well, you can, but you get it penalised. Not penalised from the sense that there's no penalty, but you'd have a lesser return. You'd only get a fraction of the interest rate you get. But you can take the money out after 7 days' notice, I might add.
Tom in Artane in Dublin asks, I took a personal loan of €12,000 3 years ago. For around a year and a half, I was repaying €76 a week. I had a pay cut. I reduced my payment to 80 every 2 weeks, and I found that the penalty interest was actually more than what I was paying. Surely the bank can't be allowed to do this. That doesn't seem very fair.
Well, I don't know whether this texter, Tom in Artane, whether you actually, just went into the bank and said, I'm doing this without negotiation, because if you did it without, as I say, a fait accompli, it's equivalent to, this is a 4-year loan at about 14%. And in reality, by reducing your repayment without negotiation, there are surcharges, which is an additional amount of interest that would have been imposed. So really what I would suggest to Tom is, first of all, go back to his lender, ask them, tell them about the personal circumstances, show them proof of the inability to maintain those payments, show them a willingness to eventually get back on track. I mean, they've got to give, some hope that, the money that was lent out originally is going to be repaid at some future stage. And then ask them for a holiday period of 6 months or a reduced amount of 12 months, but ask them to explain precisely what happens. Is there a penalty going to be imposed? Is there going to be a surcharge?
Yeah, so tell them what you're doing, really.
Tell
That's
them
the main
what you're
thing.
doing. But you can't just go in and do a fait accompli, and say, I'm going to reduce it by half. Thanks a lot,
Okay.
lads.
The next one is one that I think that I actually want to find out the answer myself, because in my case, I signed up for my life insurance when I took out the mortgage, didn't shop around. Sure, it was 2007. Why would you do something stupid like that? The question is, could you ask the money doctor what is the best way to sort out life insurance for both commercial and domestic mortgage? I'm currently getting a mortgage from Bank of Ireland, and they are, quote, desperate to get me to talk to their broker. Why would they be so desperate to talk to an in-house broker?
Because all the lenders, they have to kind of tick the boxes. Have they upsold? Have they cross-sold? Can they add on profit basically to the bottom line? It's not just about getting the product. Like the current account, for instance, is a well-known loss leader for all the banks that operate current accounts. It's where they buy additional products or investments that they make the money. So number one, you don't have to take out cover with your lender unless they are coercing you to. So in other words, if they're going to give you the loan and you feel that you can't get it anywhere else, you may be forced to take out that policy. The second thing is, I would thank them for the quotation and make sure you get a physical quotation. When somebody says, this is how much it's going to cost you for your life cover, ask them, would you please put that on paper and give it to me so I can go home and think about it? And I really thank you, for this quotation. When you've gone home, then, you could shop around, because life cover is only mandatory, by the way, in home loans. It's not even mandatory on either commercial loans or on residential investment loans. And even then, on home loans, if you're over 50 and you have health problems, and there's a thing called loaded. If your policy is loaded, sounds disgraceful, but loaded means that you've got maybe an illness that is a risk to that insurance company, and therefore they apply a further sum of money onto the monthly repayment, right?
Yeah, okay, yeah.
So anyway, if you have those kind of problems, the lender, by the way, has the ability to waive the cover if they wish. Commercial insurance is not obligatory again, but it could be prudent, and it could be also enforced by a lender. So really, I would go to a reputable authorised advisor like MoneyDoctor, for instance, and look for a comparative quote, because then you can at least then go back to the lender and say, look, thank you very much for your quote. You gave me this. It's X amount. I got it cheaper at Y, and I'd like to give you the policy so you can assign it to the loan.
And what about idiots like me who took out life insurance with the same crowd that gave me the mortgage back in 2007 and haven't reviewed it since? Could I be saving a few bob if I shopped around?
You not only could be saving a few bob, but there's people out there, Jonathan, for instance, who maybe 18 months ago were smoking and they gave up because of Lent or whatever. And if they only knew that they would be saving 50% of their policy monthly outlay, but by the fact that they've stopped smoking. So it's never too late to review. I mean, that's the key to my philosophy, actually. Expenditure. You look at all your expenditure and you ask yourself two questions. One, do I need it? And number two, is there a cheaper or better alternative?
Okay, lots of questions there. The next two questions are pretty much answered already. They're all the same. Where to put money to keep it safe? And we'll go down to the next question after that, which is, my partner and I have been offered a house left behind by a family member for 40 grand, even though it's valued at 90 grand. The problem is that we're on social welfare, but I have a part-time job. My total weekly earnings are €450. Is there any hope of getting a mortgage? A family member is willing to go as guarantor. So therefore, difficult situation for them to find themselves in, trying to get a mortgage when their income is relatively small.
It is indeed, Jonathan. Unfortunately, in this particular case, there is no chance they'll get it from a Main Street lender. They won't even get it from a subprime lender. The social welfare would never be enough anyway to warrant a mortgage, because, if you look at job seekers allowance, it's €188 a week. That's €9,776. Most of the lenders now have a minimum requirement of 25,000. The second thing is that they want to have a permanent and full-time occupation that is secure. So that's why, for instance, the public sector are so much in demand by lenders and still regarded as, the secure, safe job. And the third thing, you could go to go to that party, for instance, who were willing to guarantee the mortgage and ask them if they have the full ability to repay it on their own. Would they go as a mortgagor and do a co-mortgagor ability, where both of them go on the mortgage, and even though the other party doesn't have the ability to pay, but because the other co-mortgagor has, the lender might be more averse to giving the loan out.
Okay, very good. John, as usual, time has beaten us again. Lots more questions that we need to get to. We'll get to them next week. Money Doctor John Lowe, available for consultations or over the phone. MoneyDoctor.ie is his website. John, talk to you again next week, sir.
Pleasure, and good afternoon, Jonathan.
Personal Finance on Lunchtime. Brought to you by the Irish Times. Now with dedicated daily business supplements.